Today we will discuss Unit 3 of International Financial Management. This is regarding BOP, Balance of Payment and Exchange Rate. First, I will tell what are the learning objective of my class. In this class, after doing this class, you can understand different type of international financial flows. You will able to record international financial flows in a prescribed format known as BOP. You will understand the format of BOP. You will understand the nature of equilibrium and disequilibrium of BOP. What is equilibrium of BOP and what is disequilibrium of BOP? And we can know the adjustments if disequilibrium occurs. Then we will discuss different recent trends in India's BOP or balance of payment statement. First, let me tell you the structure of my discussion. First, I will give an introduction to the topic. Then we will discuss regarding the recording of BOP transaction. Next, we will discuss form of international flows. Next, structure of BOP, equilibrium, disequilibrium, and adjustment. Next, we will discuss India's BOP. I will summarize my discussion. We will discuss some self-assessment question and further reading. Friends, in case of international business, there is inflow and outflow of foreign currencies. The statement which records inflow and outflow of foreign currency of a country for a particular period is known as balance of payment. So, balance of payment is a statistical record of a country's inflow and outflow of foreign currencies. So, BOP, what is BOP? BOP statistically, systematically summarizes the economic transaction of a country with the rest of the world. For the purpose of BOP, the entire nation is to be classified into two parts. What are the two parts? If it is globe, then what is this? A country is there and others, A is the country, others are rest of the world. So in this case, we will discuss the transaction between country A and rest of the world. And this record, a systematic record of the transaction between country A and rest of the world is known as BOP statement. So BOP is a statistical statement. It summarizes economic transaction of a economy of a country with the rest of the world. So BOP is an account aggregation of all relevant international transactions carried out by resident of a country with non-residents. So what is resident of a country? Who is the resident of a country? Now let's take an example. A is a country. Country A. Who are the resident of country A? Country's residents are corporations of the country, individuals of the country, and government agencies of the country. And if the residents of country A do any foreign transactions than any other country, resident of other country, resident of other country is known as non-resident. So the transactions between resident of a country to with non-resident is known as, is recorded in a statement that is known as balance of payment. So BOP is a systematic record of all international transactions carried out by a resident of a country with non-resident. Who are non-residents? Non-residents are corporates, individual, government agencies of other countries. The transactions between them are recorded in a statement. That statement is known as balance of payment statement. Hence, I can tell that BOP is a systematic record of a country's international transaction with the rest of the world. So, BOP is a statement. BOP is a statistical statement. The statement contains two parts. One is inflow of foreign currency and another is outflow of foreign currency. So, there will be balance or deficit. If inflows are greater than outflows, if inflows is greater than outflows, what will happen? There will be BOP surplus. What is BOP surplus? When BOP surplus will occurs, BOP surplus will occur when a country's inflow of foreign currency is greater than outflow of foreign currency. And when BOP deficit will occur, BOP deficit will occur when inflows of foreign currency is less than outflow of foreign currency. In that case, there will be BOP deficit. So two terms we have understand: surplus and deficit. How surplus is computed? When inflow is greater than outflow, it results in BOP surplus. When inflow is less than outflow, it results in BOP deficits. Okay. Now we will discuss how transactions are recorded in BOP statement. Before discussing this, let me first try. There are two types of transactions in BOP. One transactions results in inflow of currency. Another transactions results in outflow of currency. Okay. Now the inflow of currencies are credit items. So what is credit items? There are two items in BOP. There are certain credit items. What is credit items? Credit items are those items which results in inflow of foreign currency. And there are certain debit item, inflow of foreign currency. And there are certain debit items. What is debit items? In case of BOP statement, debit items are those items which results in outflow of foreign currency. So there are inflow of foreign currency, there are outflow of foreign currency. Inflow of foreign currency are credit items and outflow of foreign currency are debit items. So there will be two type of items: credit items and debit items. So the BOP statement is recorded under double entry bookkeeping system. What is double entry bookkeeping system? Under double entry bookkeeping system, items are recorded in debit credit forms. So credit items or credit entry are those entry which results in inflow of foreign currency, and debit entry are those entry which results in outflow of foreign currency. So we will understand more on the credit items and debit items. What is credit items? Credit items are CR items, export of goods and services. When a country export goods, it receives foreign currency, so it's a credit item. Income receivables, if there will be foreign income receivable, it is a credit item. Unrequited transfer receipts, if there is any transfer, a country transfer some money to another country, that is known as credit items. Reduction in foreign assets, reductions in foreign assets means sale of foreign assets. When you sell any foreign assets, foreign currency inflows into your country. Increase in foreign liability, foreign liability means foreign loan. If you take foreign loan, there will be inflow of foreign funds, so it is a credit items. So credit items are over. Then there are certain debit items. What is debit items? Debit items will result in import of goods and services. When you import goods and services, foreign currency goes out of the country. So these are debit items. Next, income payable on requited transfer payments. Income payable, foreign income payable. If there are certain foreign income which you have to pay to residents of other country, those are debit items. Unrequited transfer payments. What is unrequited transfer payments? That means the citizens of a country make payments to their relatives outside. That those are transfer payments, and that is remittances. So the remittances sent out of a country are debit items. Next, increase in foreign assets. When you buy foreign assets, foreign currency goes out of the country. Therefore, it is a debit item. Then reduction in foreign liability. Foreign liability means loan. When you repay a foreign loan, foreign currency goes out of your country, that is a debit item. So in BOP statement, there will be certain credit items and there will be certain debit items. Next, in BOP statement, there are two type of headings under which transactions will be recorded. One heading is current account, another heading is capital account. So there will be some current account transactions and there will be some capital account transactions. What is current account transaction? We will discuss. Current accounts are the accounts of recurring items, and capital accounts are the transactions of non-recurring items. We will discuss. In current account, what are the things to be recorded? In capital account, what are the things to be recorded? But please understand, under current account and capital account, we record the transactions on which basis? On gross basis. What is gross basis? Gross basis means there are two items, debit and credit. Suppose there is a item, that is one item is there, transfer payment, transfers. Transfers, debits are 10,000, credits are 5,000. So we will record, or 4,000. Let's take an example, 4,000. So we will record debit 10,000, credit 4,000. This is known as gross entry. But if you will net it, we will record only 6,000 debit. It is known as net entry. The current items are put under current account or capital account items are put under gross entry system. The financial accounts transactions are recorded under net entry. So there are two type of transaction, current and capital accounts. Those are recorded on gross basis, whereas the financial items accounts are recorded on net basis. So there will be gross basis of recording, there will be net basis of recording. Gross basis means you have to put both debit and credit items, and net basis means you have to net it, debit minus credit or credit minus debit. The net items, net amount is to be reflected in BOP statement. Next, in BOP, you have to follow a uniform valuation system. You have to value the assets and liabilities on a uniform basis, so that there will be consistency in BOP record and there will be international comparability of BOP statements of different countries. So what are the system of valuations? We generally follow the imports and exports of different countries are recorded at their FOB value. What is FOB? FOB value. FOB means free on board value. Similarly, the transactions of financial assets and liabilities are recorded exclusive of any commission, fee, tax which are charged. Okay. Next, we always record the transactions on accrual basis, not on exact basis or cash basis. We record BOP transactions on accrual basis. Okay. So before discussing more on BOP, let's discuss what are current account transactions, what are capital account transactions. So in case of BOP, there are the transactions which to be categorized into two parts. One is current account, another is capital account. So what is current account transactions? I have told that current account transactions are recurring transactions. In current account, we record two things. We record mercantile items and non-mercantile items. Mercantile items and non-mercantile items. The mercantile items are known as goods or visibles. These are known as visibles. And non-mercantile items are known as invisibles. So in current accounts, we record two things, visibles and invisibles. Current accounts is recorded two things. One is visibles those are mercantile items, and invisibles, those are non-mercantile transactions. Okay, the visibles are goods. Any transactions related to goods are to be recorded in current account. Import of goods and export of goods. Import of goods is a debit item and export of goods is a credit item. Import of goods results in outflow of cash, therefore it is a debit items. Outflow of goods results in, or export of goods results in inflow of cash or foreign currency, therefore it is a credit items. And in case of non-mercantile or invisibles, it is to be classified into three parts. One is known as services. Second is known as transfer. And third is known as income. Services, transfers, and incomes. So the non-mercantile or invisibles are further classified into three parts: services, transfers, and incomes. Okay, so what is services? First we will discuss visible items. We have already discussed. It refers to goods. It refers to export and import of goods. Export of goods and import of goods. Exports are credit items, imports are debit items. Now we will discuss regarding invisibles or services. In case of invisibles, we will discuss services. What is services? Services are refers to different type of services, foreign services which we enjoy, like transportation, travel, insurance, GNI, miscellaneous services. And these miscellaneous services are further divided into software services, business services, financial services. If there is import and export of transportation, import and export of travel, import and export of insurance service, import and export of GNI service, and miscellaneous service, software service, business services, financial services, all are recorded under services in current account. Am I clear? Current account transactions, visibles and invisibles. Visibles refers to goods. Invisibles refers to three things. One is service. Next one is transfers. Okay. So next we will discuss what is transfers. Second one is transfers. Third one is yours visibles, invisibles. Visibles refers to goods, invisibles refers to services. Next, transfer. Transfers may be transfer receipt or transfer payments. These are unilateral transfers. Unilateral transfer receipt, unilateral transfer payments. So we will discuss what is transfer, unilateral transfer receipt and unilateral transfer payments later on. Then incomes. These incomes are factor incomes. Factor income received and factor income paid. We will discuss what are the factor income. Factor incomes are incomes from foreign assets. We will discuss how foreign assets income received, foreign assets income paid. So current account consists of two things: mercantile items, non-mercantile item, technically called visible items and invisible items. Visible items related to goods, invisible items related to three things: services, unilateral transfers, and factor incomes. Services, transfer, and incomes. These are the three items which are recorded under current account. Next, we will discuss capital account transaction. What is capital account transaction? Capital account transactions are recorded. There are three things which will be recorded in capital account. These are the transactions related to capital account. Transactions are related to two things. Capital account. One is foreign assets and foreign liabilities. Foreign assets and foreign liabilities. We will discuss subcategory of these capital account transactions. But you remember, capital account transactions are the transactions relating to foreign assets, foreign liability. What is foreign assets? Foreign assets are foreign properties. Foreign liability as foreign loans. The transactions related to foreign properties and foreign investments are recorded in capital account. Similarly, transactions related to foreign loans are recorded in capital account. Okay, so we will discuss in detail regarding this. Let me first go to form of international financial flow. What are the different form of international financial flow? The forms of international financial flows can be categorized under current account and capital account. What are the current account forms? Current account forms are first trade. What is trade? Trade related to goods. Trade means import of goods and export of goods. Trade related to mercantile trade. Okay. So mercantile trade, it may be import of goods or export of goods. Import of goods results in outflow of funds and export of goods results in inflow of funds. The difference between inflow and outflow of funds in relation to trade is known as trade balance. What is trade balance? How trade balance is calculated? Trade balance is equal to export of goods minus import of goods. If a country's export is greater than, if export is greater than import, then there will be trade surplus of what? Of goods. There will be trade surplus. A country can have trade surplus if exports are less than imports in relation to goods only. This is known as trade deficit. So in a transaction, there can be trade surplus or there can be trade deficit. A country can face trade surplus or a country can face trade deficit. Okay. So first one is current accounts. First item is trade. Second item is invisibles. Trade related to mercantile or visibles. Trade means visible items. Visible means goods. There can be transactions related to invisibles. I have told that the invisibles are classified into three parts. What are the three parts? We have already discussed invisibles classification. First part is related to foreign services or services. Second is incomes, that is investment incomes. And third one is unilateral transfers, that is transfer payments or transfers. So invisibles, first foreign services. Foreign service means if you import some foreign service or export some foreign service, and as a result of which you have to pay foreign currency or receive foreign currency, these transactions are recorded under services. India is a largest exporter of IT services through the world. We export majority of IT services. We import majority of financial services from the world. So what will happen? So IT services export are credit items, financial services imports are debit items of invisibles. Okay, so services over. Next one is investment incomes. What is investment income? Investment income refers to income from foreign investment. What is income from foreign investment? Suppose you buy share of Microsoft. Microsoft will pay you dividend and the dividend will result in inflow of funds to India. So it's a foreign currency receivable. So it refers to receipt and payment of dividends on foreign assets. Receipt and payment in relation to technical services, receipt and payments in relation to fees, receipt and payments in relation to royalty, receipt and payments in relation to interest on loan. These are known as investment incomes. Okay. Next, another item is there, that is unilateral transfers. Investment incomes are over. Let's take an example. You have a home in USA. You have put it on a rent. Then the rent, foreign rent, will come into India. So it's a investment income, and it results in inflow of funds. Similarly, suppose a UK citizen has a home in India. It put the home on a rent in India. Then the rent from India will go from India to UK. So it results in outflow of foreign currency. So it's a debited. The similarly, foreign rent can be credit or can be debit. It depends upon whether you are receiving the foreign income or you are paying the foreign income. Okay. Next one is unilateral transfer. Uni means one-sided. In a transactions, there are two parties, but there are certain unilateral transfers. That means there is unidirectional transfers. There is no transactions, but one party gift another party. That will results in unilateral transfers. Gift. Suppose you gift something to a friend who resides in UK, who is a citizen of UK. You give something. That means the foreign currency will move from India to UK. So foreign gifts results in unilateral transfers. Foreign assistance results in foreign remittances. What is foreign remittances? Suppose your son or daughter is working in Dubai. From Dubai, they are sending some money to India. So it is not a transaction, it is a remittance. It's a unilateral transfer. Transactions occurs if there is transfer of goods or services, but it is only transfers, unilateral transfers. We are receiving a major portion of our foreign currency inflows in form of remittances from NRIs who are residing throughout the world and sending money to their near and dears who are residing in India. Okay, so foreign remittances are a form of unilateral transfers. Similarly, a UK citizen may reside in India and working in India and send money to his family who are residing in England. That will be unilateral transfer payments, that is remittances outwards. So there can be remittances inward, remittances outward, gift inward, gift outward. These are unilateral transfer payments. So we have discussed regarding items of current accounts. Those are clear. Current account transactions related to two things, visibles and invisibles. Visibles refers to which items? Goods. And invisibles refers to three things. What are the three things? First one is services, foreign service, foreign investment income, foreign unilateral transfers. Next, we will discuss certain items of capital account. I have told that capital account refers to transactions related to foreign assets and foreign liability. Capital account consists of four parts. What are the things recorded in capital account? Capital account consists of four parts. Capital account consists of, first one is foreign investment. We'll discuss what is foreign investment. Second one is external assistance. Third one is external commercial borrowing. External commercial borrowing, ECBs. And the last item is capital account, the last item is short term flow of funds. Short term flow of funds. So capital account records these four things. We'll discuss all these things. Short term flow of funds. Current accounts records only two things. One is visibles, another is invisibles. Capital account records four things. Foreign investment, external assistance, external commercial borrowings or ECBs. Next, short-term flow of funds. These four items are recorded under capital account. So first, foreign investment. What is foreign investment? We will discuss. What is foreign investment? Foreign investment may be of two types. One is foreign investment in your country, citizens of outside investing money in your country, that is called to foreign investment inward, or your country's resident investing outside your country, that is foreign investment outwards. The foreign investments can be classified into two parts. One is known as foreign direct investment, FDI. Another is known as foreign portfolio investment, FPI. So foreign investment is of two types, foreign direct investment or foreign portfolio investment, FDI and FPI. What is foreign direct investment? If the investments are made in foreign physical assets, those are known as foreign direct investment. Foreign physical assets means you go and purchase a factory in foreign, you go and purchase a home in foreign country, physical assets. If the investments are in foreign securities, foreign country companies share, bond, debentures, those are known as FPI investments. So there can be FDI flows or there can be FPI flows. FDI flows means foreign investment related to physical assets. FPI flows refers to foreign investment related to securities, foreign securities. Okay. Now FDI and FPI inflows and outflows are recorded under capital account heads. FDI inflow results in inflow of funds and credit item. FDI outflow is a debit items. FPI inflow is a credit items. FPI outflow is a debit items. Okay, so foreign investment is one there. Next one is external assistance and external commercial borrowing. What is external assistance? Normally, external assistance are given by a country to another country. Let's take an example. Suppose there is a earthquake in Nepal. Indian government wants to provide some assistance to Nepal in form of some loan. That is external assistance. Suppose these loans normally carries a low rate of interest, and in many cases there is no, we generally give the loan in form of grant. That means we give foreign grants and you do not have to repay it back. Okay, that is external assistance. And what is external commercial borrowings? What is external commercial borrowing? In case of external commercial borrowing, you borrow money from foreign entities. Okay, when you borrow money from foreign entities, you normally borrow at a market interest rate, and there is always a condition that you have to repay it back. So this is the main point of difference between external assistance and external commercial borrowings. These are government transactions, external assistance. External commercial borrowings are normally financial transactions. Okay, so these are official transactions, external assistance, and these are private transactions normally. Okay, next, normally the external assistance are done at a below market rate of interest, but it is done at a market rate of interest, external commercial borrowings. Okay, next one is normally external assistance is manifest upon a outright grant. It may be in form of grant, so there is no requirement of repayment in case of external assistance. There can be, but always there is a repayment schedule attached with external commercial borrowings. Next thing is, we also record in capital account the short term flow of funds. What is short term flow of funds? Short term flow of funds are movement of funds related to banking channels, movement of funds between banks, Indian bank, foreign bank. The movement of funds between them are recorded in capital account transaction. The movement of funds in form of euro notes, movement of funds is related to speculative and arbitrage activities and normally recorded in capital account transactions. So there are two account transactions: current account, capital account. Current account records visibles, invisibles. Capital account records transactions related to foreign. Four things. What are the four things? Foreign investment, external assistance, external commercial borrowings, and short-term flow of funds. Okay. Next, we will discuss structure of balance of payment. What is the structure? How balance of payment looks? What are the components of balance of payments? We know that there will be two components: current account and capital account. Current account transactions will be there. First is current account. We have already completed current account. What is recorded here? There are two things are recorded. One is visibles, another is invisibles. Clear? Next one is capital account transaction. What is capital account transactions? We have already discussed capital account transactions. In case of capital account transactions, what do we record? We record four things. Yeah, we can classify it into four parts. One is foreign investment. Next one is external assistance. Next one is external commercial borrowings and short-term movement of funds. These are the things which are recorded in capital accounts. Okay, these two parts are over. We have already discussed. Next, the third category of items which is there in a country's BOP is statistical discrepancy. What is statistical discrepancy? It is also known as error and omission. What is error and omission? While compiling the transactions of current account and capital accounts, there may be some errors, and these errors and omissions are recorded under statistical discrepancy. Okay, so this statistic, why error occurs? There can be four reasons why error occur. It can arise because of difficulties involved in collecting. It is very difficult to collect and compile the data of an entire country, and there will be not a single errors. There might be some errors, and these errors will be checked and balanced under statistical discrepancy or under error and omission. Second reason can be there will be movement of funds may lead or lag the transactions. Leading and lagging transactions, error occurs. Third is we have to estimate many things under BOP, and there can be wrong estimations that can be reaching. And the fourth point why it occurs, that is error and omissions may occur due to illegal transactions. There might be many illegal transactions, and these illegal transactions may result in inflow of funds or outflow of funds. Let's take an example. One terrorist is captured by Indian police, and from there we get some dollars in his possessions, and this is a illegal transaction. Now, can we record it in current account or capital account? No, this will be kept in which of third statistical discrepancy account. Okay, so three parts is there: current account, capital account, and capital discrepancy. A, B, and C. If we will add A, B, and C, we will get the overall balance. So what is overall balance? Overall balance is D. D कैसे निकलता है? D is equal to A plus B plus C. What is A? A is current account. What is B? B is capital account. What is C? C is error and omission. E and O. If you will add all these things, we will get overall balance. The overall balance may be positive or it may be negative. If the overall balance is positive, it is known as BOP surplus. If the overall balance is negative, it is known as BOP deficit. Okay, current account, capital account, and error and omission. Okay, there can be BOP surplus or BOP deficit. This is known as overall balance of, that is BOP statement. Next we will discuss another concept is there, that is known as official reserve account. What is official reserve account? Okay, we know that in current account there can be surplus or deficit. In capital account there can be surplus or deficit. In error and omission there can be positive or negative. So let's take an example. What is official reserve? Now please see, suppose this is the BOP statement. BOP statement. I will show a BOP statement to you, but there is a wrong. In current account, suppose in BOP statement there are two accounts. Current account, you have a positive balance. What is positive balance? Positive balance is 100. What is 100? This is net inflow. Net inflow of foreign currency is 100. In capital account, there is a deficit of, let's take an example, there is a deficit of, let's take an example, 50. Deficit. What is deficit? Deficit means net outflow. And there is error and omission. Let's take an example. There are 10 error and omission, that is net outflow. So if we add all these things, we will get a balance of 100 minus 50 minus 10, that is equal to 40. That is BOP surplus. Now you see, this BOP surplus will result in, if there is BOP surplus means you receive 100, you pay 60, and this 40 will add to the official reserve of India. Every country maintains foreign currency reserve, and if there is a BOP surplus, this will be added to official reserve. Okay, so current account 100, capital account, you know, let's take an example. Suppose official reserve, so in this case there will be increase in official reserve. So when there will be increase in, there can be two types. One is increase in official reserve. Increase in official reserve. Increase in official reserve, when it will occur? It will occur when there will be BOP surplus. If there will be BOP deficit, it will result in decrease in official reserve. Okay, so these are different components of BOP of a country. Let's take an examples. We will see a BOP statement of a country. India. India's BOP statement of 21-22 amounts in crores. First, current account. Current accounts, there are two things. First, goods, visibles. Goods, two things: export of goods, import of goods. If we minus, we get BOP deficit. How much BOP deficit is there? That is trade deficit. This is known as, we have a trade deficit. Then we have what is invisibles. Under invisibles, there are how many items? There are three items: services, income, transfers. And if you will add these, there are certain items. There will be, if we add visibles with invisibles, we will get current account balance. What are the current account balance? That is, current account balance is negative. That means it is current account deficit. Current account deficit. Then we will record which transactions? Capital account transactions. Under capital accounts, four important steps are there. What are the four steps? One is FDI, FPI, external assistance, external commercial borrowing, short term close. And the net one is, please see, this is a positive balance of capital account. Therefore, there is a capital account surplus. Next, C item is statistical discrepancy. I have told statistical discrepancy related to E and OE. What is E and OE? Error and omission. If you add A, B, C, we will get overall balance of payment. So this is, we will get BOP surplus. When there is BOP surplus, there will be, what will happen? There will be your net increase in forex reserve. Net increase in forex reserve. So this is the balance of payment of a country. Next we will discuss equilibrium or disequilibrium of balance of payment. What is equilibrium of balance of payment and what is disequilibrium of balance of payment? In order to understand equilibrium and disequilibrium of balance of payment, we have to understand the items of BOP. BOP, there are two types of items. One is current account. Second one is capital account. Third one is error and omission. And next one is official reserve. The current account, capital account and error and omission combinedly, these are known as autonomous transaction. And official reserve is a compensating transaction. If we add autonomous transaction and compensating transaction, the balance will always be zero. Because balance of payment always balances. If there will be BOP surplus, there will be increase in official reserve. BOP surplus is 50, increase in official reserve will be 50. Therefore, the BOP statement will balance always. Okay, but it is a accounting equilibrium. In accounting sense, the BOP statement always balances. But if you will consider only autonomous transactions, what is autonomous transaction? Only current account, capital account, error and omission only, then there may be surplus or deficit in the BOP statement. So BOP statement surplus or deficit is known as BOP disequilibrium. So if there is surplus or deficit in BOP, that is known as BOP disequilibrium. Okay, if we consider official reserve transactions with autonomous transaction, BOP will balance in accounting sense. But in economic sense, there can be surplus or deficit or BOP disequilibrium. If there is BOP disequilibrium, how we will adjust it? There are three approaches of adjustment of BOP disequilibrium. BOP disequilibrium adjustment. Three approaches. What are the three approaches? First one is classical approach. This approach tells that you should not do anything to adjust the BOP. It will be automatically adjusted. Automatic adjustment of BOP. And government should do automatic adjustment. and government should not do anything. Government should do follow a policy of laissez-faire. Laissez-faire means government should not do anything, and BOP will be automatically adjusted. How BOP will be automatically adjusted? It tells that when the BOP is in deficit, it will result in outflow of gold in those classical time commodity specified standards. It will result in outflow of gold. When there will be outflow of gold, there will be decrease in money supply in the economy. When there is a decrease in money supply in the economy, the prices of goods and services will come down. When there will be prices of goods and services comes down, the goods will be cheaper and it will be competitive in foreign market. So ultimately export will increase, import will decrease, as a result of which balance of payment will be automatically adjusted in the long run. So in the long run, it will be automatically adjusted. This is the advocacy of classical approach. Second approach of BOP adjustment, that is elasticity approach. Elasticity approach tells that BOP adjustment can be done through either revaluation of currency or devaluation of currency. But the success of elasticity approach depends upon the elasticity of demand for export and import. And third approach is given by Keynes, the Keynesian approach. The Keynesian approach tells that the BOP adjustment can be done through fiscal and monetary policies. Which policies? Fiscal and monetary policy. With fiscal and monetary policy, we can adjust our national income, and by adjusting national income, we can solve the problem of BOP disequilibrium. So government should, if a country should follows which BOP deficit, it should follow contractionary policies, fiscal and monetary policies. Okay, next and third point is Keynesian approach. So under Keynesian approach, that tells that your government must follow fiscal and monetary implications. A deficit country should use contractionary policies. What is contractionary policies? It will impose higher taxes, it will spend less on public expenditure to reduce the absorption and core imports. That is Keynesian approach. And the third approach is known as monetarist approach. What is monetarist approach? Monetarist approach tells that BOP disequilibrium is a monetary phenomenon. If it is a monetary phenomenon, by controlling the money supply in the economy, we can adjust the disequilibrium in BOP. So what is the policy implications of monetary approach? The policy implications is the focus should be controlling domestic money supply. Focus should be controlling domestic money supply. Controlling domestic money supply. You can control domestic money supply and address the problem of BOP. How you can control domestic money supply? By government should slow the growth of domestic credit. It has to slow the growth of domestic credit. You know that the credit creation is done by commercial banks, and the credit creation can be controlled by Reserve Bank of India through monetary techniques, quantitative techniques, qualitative techniques. It can adjust the quantitative and qualitative techniques, repo, reverse repo, bank rate. All these techniques they can adopt to, but curb the money supply in the economy or expand the money supply in the economy, as a result of which they can adjust the BOP deficit or BOP surplus. Okay, so there are three approaches: classical approach, Keynesian approach, monetarist approach. Classical approach tells that government should do nothing, laissez-faire economy. Keynesian approach tells that government should manage the demand through change of national income through fiscal and monetary policy. And monetarist approach tells that government should focus upon controlling domestic money supply to curb the effect of disequilibrium in BOP problems. Okay, these are the three approaches. Practically, the throughout the world, the monetary authorities or governments follow the essence of all these three. That is known as eclectic approach of managing deficit in BOP. Next, we will discuss foreign exchange reserve. We know that every country must have some forex reserve. India has forex reserve. Okay, it's rounding 600 or 700 billion dollars, 6 to 700 billion dollars. Forex reserves. Forex reserves keeps on increasing or decreasing related to forex transactions, foreign exchange transactions. If there will be BOP deficit, the forex reserve will come down. If there will be BOP surplus, the forex reserve will increase. And the forex reserves are kept in four forms. So we will discuss different forms in which forex reserves are kept. Forex reserves are kept. Forex reserves are kept in four forms. What are the four forms of forex reserve? One is foreign currency. The official reserve of a country consists of foreign currency. There are certain UA dollar reserve, euro reserves, yen reserves. These are foreign currency reserve. There will be certain monetary gold. What is monetary gold? That gold which is in the name of the monetary authority of a country, that is known as monetary gold. The gold held by Reserve Bank of India in India is known as monetary gold. It consists a part of forex reserve of country. Second one is some portion of forex reserves are kept in form of SDR. What is SDR? Statutory drawing rights. We know SDR is a currency or a unit of account of IMF. It is as good as gold. SDRs. Is the value of SDR depends upon the value of five currencies. Okay, so it is the weighted average value of five currencies. SDRs, special drawing rights. SDRs, it's the unit of accounts of special drawing rights. Unit of accounts of IMF. Next, the forex reserves are in form of fourth, reserve transpositions, RTPs. What is reserve transpositions? We know that each and every country contributes something to the IMF, and the IMF contributions are of two parts. 25% of IMF contribution of the quota of IMF are to be paid in SDRs or foreign currency. And that 25% which you have kept with IMF, and the other 75% you can keep in by paying different combination of gold or your own currency, foreign currency. There are many things. And the 25% that is known as reserve transpositions. So you can withdraw it at any time without any restriction. That is known as RTPs. And the forex reserves are in other forms. What are the other forms in which forex reserves are there? We'll discuss. The other forms in which forex reserves are there of a countries are reserves, loans to non-residents, deposit keeping corporation, long-term loans to an IMF trust, and that are readily available, loans arising from reverse repo transactions, and all these things are forming part of forex reserves of a country. Okay, so we have discussed today regarding BOP, balance of payment. It is a statistical record of a country's import and export. What are the assessment questions? You can find out what are the different kind of international flows, comment on structure of BOP, how trade deficit can be reduced or eliminated, then compare elasticity approach, Keynesian approach, and monetarist approach of addressing BOP disequilibrium. And there are certain short notes: invisibles, autonomous and accommodating transactions, statistical discrepancies in BOP, which is known as error and omission. All these things we have already discussed. These are certain further reading references in context of BOP. Thank you. Thank you for attending my class. Thank you all. Thank you.